Welcome to today's deep dive. We're going to be exploring how financial analysts, well, they might actually hold the key to better investment strategies. You know, we always hear about analysts making stock predictions right.
Right.
But today we're going to take a step further. We're going to look at the connections between the companies they cover, and we're going to discuss why that might be a game changer for investors like you. Joining me is an expert in financial markets, and they're going to help break down some really fascinating new research on this very topic.
Absolutely. Yeah. It's all about, looking beyond just individual companies and instead understanding the web of relationships that tie them all together.
Okay, let's unpack this. Our source material today is an academic paper. It's titled Extracting Alpha from Financial Analyst Networks. Now, I know the title might sound a bit daunting, but trust me, it's worth diving into. It combines network science and machine learning. And the findings are really intriguing. So the paper argues that by analyzing these networks of companies linked by the analysts who cover them, we can uncover some hidden connections, connections that traditional analysis might miss. What were your initial thoughts on this approach? I mean, were you skeptical at all when you first encountered this idea?
Well, I think my initial reaction was a mix of curiosity and, a bit of skepticism. Because after all, the idea that you could gain an investment edge simply by looking at who's covering which companies, it almost sounds too good to be true, right?
Right.
But as I delved deeper into the paper, I started to see the potential. Because they're not just randomly connecting companies, they're looking at very specific relationships based on analyst coverage, which itself is based on a lot of research and expertise.
That makes sense. It's not just about blindly following analysts. It's about understanding the patterns that emerge from their collective knowledge. So, to make sure we're all on the same page, let's get into the nitty-gritty. How are these analyst coverage networks actually built?
So imagine a web where each dot represents a company. Now, if an analyst covers, let's say it, both Google and Apple, you draw a line between those two dots, and that line represents a connection, a link, based on shared analyst coverage. The more analysts covering both companies, the stronger that connection becomes.
So it's not just a binary yes or no, covered or not covered. It's a weighted network.
Right. The strength of the connection depends on the number of analysts covering both companies. I'm starting to see how this could reveal relationships that wouldn't be immediately obvious, just from looking at traditional financial data.
Exactly. Yeah, it's like looking at a company's ecosystem, not just its individual performance. The paper gives a really interesting example. It's of an energy provider, WMB, and it's being connected to companies in completely different industries, like an agro-industrial company, GIS, and a healthcare company, HSIC. It seems counterintuitive, but it suggests that analysts might be indirectly pointing to deeper economic relationships.
You're spot on. What's fascinating here is that the network seems to be picking up on fundamental links. Links that traditional analysis, which often focuses on things like industry classifications or direct correlations, might miss.
Okay.
Think about it. These seemingly disparate companies, they might be part of a shared supply chain. They might have overlapping investor interest or even rely on similar raw materials or technologies. These are connections that a correlation matrix, for example, might completely overlook because it can't capture these less obvious, more complex relationships.
This is reminding me of that saying, it's not what you know, it's who you know. But in this case, it's more like it's not just what the companies know, it's who's paying attention to them. And that attention could be a sign of future performance or potential synergies. The paper goes on to actually develop a trading strategy based on this network. And this is where things get really interesting. They use something called a graph attention network, or GATE, which sounds very high-tech. What were your initial thoughts when you first encountered this concept? Did it make intuitive sense to you?
The idea of a machine learning model that could understand the nuances of a network like this, it was initially quite intriguing. And the choice of a graph attention network, or GATE, it was particularly clever. What struck me was the idea of attention. This means the model doesn't treat all connections equally. It learns to focus on the most informative relationships for making predictions, much like how we as humans might pay attention to certain cues when analyzing a situation. That's where the real power of this approach lies, I think. It's not just crunching numbers, it's understanding context.
That's a really helpful way to put it. So it's not just looking at numbers in a spreadsheet. It's actually understanding the relationships between companies. Can you break down how a GAT actually works?
Okay, so imagine this network of companies connected by those analyst coverage links. The GAT takes in this entire network along with data about each company, like its stock price history. Now, the brilliance of the GAT is that it doesn't just treat each company in isolation. It also considers the structure of the network. and how each company is connected to others. And here's where the attention part comes in. The GAT learns to assign different levels of importance, or attention weights, to each of those connections. It's like the model is saying, okay, this connection between company A and company B is really interesting and might be a strong predictor of future performance, so I'm going to pay more attention to it.
So it's like shining a spotlight on certain connections while dimming the lights on others. It's not treating all relationships as equally informative.
Precisely. It's recognizing that some connections are more meaningful than others. And by focusing on those key relationships, the GAT can potentially uncover hidden patterns and make more accurate predictions.
This is blowing my mind. I mean, if the model can actually identify those subtle but crucial connections, the ones that might signal future trends, that's a pretty powerful tool for investors, wouldn't you say?
Absolutely. It's about seeing the market through a different lens, one that takes into account the interconnectedness of companies, in a way that traditional analysis often misses.
Okay. But let's get down to brass tacks. Does this actually work? Does using a GAT on this analyst coverage network translate into real-world investment benefits? I mean, it's one thing to have a cool theory, but does it actually hold up in practice?
Well, that's the exciting part. The researchers actually tested this trading strategy using historical data, and the results are pretty remarkable. The strategy that used the analyst network and the GAT model consistently outperformed other strategies, including some very common ones.
Wait, hold on. Before you tell us how it performed, you have to tell us what they compared it to. What were those other strategies?
Great question. They compared the GAT model to a basic market long-only strategy. This essentially means you just buy all the stocks in the market with equal weights. Kind of a simple, hands-off approach. They also tested it against a strategy based on a popular technical indicator called MAED, which stands for Moving Average Convergence Divergence. It's a way of identifying momentum and potential buy or sell signals. So these are not just straw man comparisons. They're testing it against legitimate, commonly used investment strategies.
Okay, now I'm on the edge of my seat. Tell us, how did the GAT models stack up against these other approaches?
The results were striking. The market long-only strategy had a Sharpe ratio of only 0.411, while the MAMTD strategy did better at 0.672. But the GAT model, it achieved a Sharpe ratio of over 4.
Okay, for anyone listening who's not familiar with Sharpe ratios, can you quickly explain what that number signifies and why a higher one is better?
Absolutely. The Sharpe ratio is a way to measure risk-adjusted returns. It basically tells you how much return you're getting for each unit of risk you're taking. So a higher Sharpe ratio means you're getting more bang for your buck, so to speak. You're getting better returns without taking on proportionally more risk.
So in this case, the GAT model is delivering significantly higher returns for the same level of risk, or even less risk, compared to those other strategies. That's impressive. But was it just about the raw returns? Were there any other benefits to using this approach?
Here's what's really interesting. Not only did the GAT model outperform on returns, but it also had significantly fewer and shorter periods of loss. Those drawdowns we talked about earlier, this means you're not just making more money, but you're also experiencing fewer of those gut-wrenching drops in your portfolio. It's a smoother ride overall, which can be really important for investors, especially those who might be a bit more risk-averse.
So not only is it potentially more profitable, but it's also potentially less stressful. Sign me up. But let's be real, no investment strategy is perfect. Were there any downsides or caveats to this approach that we should be aware of?
You're absolutely right. There's no such thing as a guaranteed win in the market. And the researchers do acknowledge that this model, like any other, has its limitations. One thing they point out is that its performance can be sensitive to factors like trading costs. If you're constantly buying and selling stocks based on the model's signals, those transaction fees can eat into your profits.
That makes sense. You have to factor in the real-world costs of implementing any strategy. So it's not a set it and forget it kind of thing. You have to be mindful of those practical considerations. Were there any other potential drawbacks?
Another important thing to keep in mind is that this research was conducted using historical data. While the past can be a guide, there's always a chance that future market conditions could be different, which might impact the model's performance. It's like any forecasting model. Its accuracy depends on how well past patterns hold true in the future.
So it's not a crystal ball, it's a powerful tool, but it's still subject to the uncertainties of the market.
Exactly. And that's why it's important to see this as another layer of insight, not a replacement for sound investment principles. It's about adding to your toolbox, not throwing out everything else you know.
One of the things that I find particularly intriguing about this whole concept is those attention weights that the GATE model assigns to the connections between companies. It almost feels like the model is developing a sense of which relationships are the most meaningful. Can you elaborate on how that works in practice? How does the model decide which connections to focus on?
Think of it this way. The GA is looking at this vast web of companies and trying to figure out which connections provide the most information about future performance. And it does this by learning from the data. It might, for example, notice that companies that are both heavily invested in a particular emerging technology tend to perform similarly. So it might assign a high attention weight to the connection between those companies, indicating that this relationship is particularly informative.
So it's not just about the fact that they're connected. It's about the nature of that connection. The model is learning to recognize patterns in those connections and weight them accordingly. That's fascinating. But how do we know if it's actually focusing on the right things? Is there a way to peek under the hood and see what the model is paying attention to?
The researchers actually did this. They visualized the network of connections with the highest attention weights. And what they found was remarkable. The model was highlighting connections that corresponded to real-world economic relationships between companies, relationships that often went beyond traditional industry classifications or financial metrics.
Can you give us a specific example of that?
Sure. In one instance, the model highlighted a strong connection between an energy provider and a seemingly random group of companies in various industries, including agriculture and healthcare. At first glance, there's no obvious link there. But when you dig deeper, it turns out that all those companies were heavily reliant on energy for their operations. So the model was able to identify this hidden dependency, this shared need for a key resource. That wouldn't be apparent just from looking at their balance sheets or industry codes.
That's incredible. It's like the model is uncovering these invisible threads that tie companies together in unexpected ways. It's seeing patterns that we might completely miss with our traditional wings of analyzing the market.
Exactly. It's a reminder that the world, especially the financial world, is far more interconnected than we often realize. And by understanding those connections, we can gain a much deeper understanding of how companies operate and how they might perform in the future.
This is all starting to make sense now. We have these financial analysts who are essentially mapping out the connections between companies through their coverage choices. And then we have this sophisticated machine learning model, the GAT, that can analyze that network and identify the most informative connections, even those that might not be obvious at first glance. And by understanding those connections, we can potentially gain a real edge in the market, uncovering hidden opportunities, and maybe even anticipating future trends. It's like we're seeing the market through a whole new lens.
It really is a fascinating way to look at things, and I think we're just scratching the surface of what's possible with this kind of network analysis.
That's what I was just thinking. The paper focused on analyst networks. But couldn't there be other types of networks out there that could be just as valuable, maybe even more so for investors?
Absolutely. Yeah, this paper is really just a starting point. We could look at networks of companies linked through their supply chains, for example. Imagine being able to see which companies are most dependent on a particular supplier or raw material. That kind of insight could be incredibly valuable, especially in today's world with all the supply chain disruptions we've been seeing.
Or what about networks based on research and development partnerships? Like if you could see which companies are collaborating on cutting-edge technologies, that could be a huge indicator of future innovation and growth potential. It's like getting a sneak peek into the R&D labs of some of the most innovative companies.
Exactly. You're thinking along the right lines. We could even look at networks based on customer relationships. If you can identify which companies are attracting a similar customer base, that could tell you a lot about emerging market trends and potential competitive dynamics. It's all about understanding the relationships, the connections that drive value in the marketplace.
This is making me think about the bigger picture. If analysts are focusing on specific groups of companies, clusters within these networks, what does that tell us about the future of those industries? Are certain industries becoming more interconnected? Are there any early warning signs we could be picking up on by analyzing these networks?
That's a very astute observation. By looking at the evolution of these networks over time, we might be able to identify emerging trends, potential bubbles, or even early signs of instability in certain sectors. It's like having a real-time map of the interconnectedness of the economy, allowing us to spot potential risks and opportunities before they become widely apparent.
This is giving me a little FOMO, to be honest. It feels like there are all these hidden connections out there, patterns and relationships that I'm completely missing. It's like everyone else is privy to this secret map. I'm just wandering around in the dark.
Well, I wouldn't say it's quite that dramatic, but it is true that this is a relatively new area of research, and there's still a lot to be explored. And that's what makes it so exciting. We're only just beginning to understand the power of network analysis in finance. And I think the next few years we'll see some incredible breakthroughs in this field.
So if someone listening to this wanted to start applying these ideas, to start looking for these hidden connections, where would you recommend they begin?
I think the first step is simply to start thinking differently. Move beyond analyzing companies in isolation and start considering the broader ecosystem in which they operate. Look for the connections, the dependencies, the relationships that might not be immediately obvious. And don't be afraid to experiment with different tools and approaches. There are a growing number of resources available for network analysis, from open source software to specialized data providers.
This has been an absolutely incredible deep dive. I honestly feel like I've gained a whole new perspective on how the financial world works and how interconnected it truly is.
I'm glad you found it valuable. It's always rewarding to share these insights and hopefully inspire people to think differently about investing.
You've definitely inspired me, and I'm sure our listeners are feeling the same way. It's like we've been given this new lens, this new way of seeing the market, and it's opening up all sorts of possibilities. So to everyone listening out there, keep exploring, keep questioning. Never underestimate the power of connections. You never know what hidden gems you might uncover. That's it for today's deep dive. We'll see you next time for another fascinating exploration of knowledge.